Well, greetings. This is Dean Tenney coming to you from my studio here in fabulous Las Vegas. We've been doing a series of, your series in 60 minutes. We started with a series 7, and we had people who were telling me they were listening to videos, audio only, on their way to the exam or the day before their exam, and they had some favorites. And I thought, well, why don't we just go ahead and make that video, and you can listen to it the day before or morning of your exam. If it's not the morning, day before or morning of your exam, then save this for later. I'll put some a video you can watch right away that is very popular for Series 24. But the idea here is you don't have a natural circadian rhythm or flow as it relates to 24. And we're hoping this will be as well received as some of our others. I mean, it's not going to be good if you're using this as kind of to get in the flow and an inventory and it freaks you out. If that's the case, by all means, stop listening. Right? Okay. Now it's going to be probably a challenge to get this done in 60 minutes. Some of them have been more challenging than others to hit the mark in terms of 60 minutes. So here we go, series 24 in 60 minutes. No slides, mainly audio, and just my mug here looking back at you. Okay, so let's start with sales supervision, which is a big part of your Series 24. FINRA is the self-regulatory organization for the securities industry. And remember, they can revoke your registration if your fees are not paid within 21 days of the notice. So they give you notice, say, hey, listen, you got to get current on your fees. Your fees are based on the number of reps you have and the number of branch offices you have. You have to make a written notice within 30 days in advance of any material change to your firm. Material is a key word. Material means it's something would alter FINRA's decision about whether they're going to say yes or no to whatever that change is to your membership agreement. Statutory disqualifications for conviction of a felony within the last 10 years or a misdemeanor involving embezzlement of monies and or securities. There are exceptions available. And if granted, remember, there's this tier 1, tier 2 of heightened supervision. There's a firm element of continuing education that you need to make sure reps have completed on an annual basis. And remember, there's also a regulatory element that must be completed within 120 days of your second registration anniversary and every 3 years thereafter. Remember, they didn't have this when I was in the Marine Corps, but I like this. If you go on to active military service, you're a reservist, you get called to active military duty, you go into a special inactive status. So the point there is there's not going to be a U5, right? U5 would be your disassociate. That's not what's going on here. You're going into a special category. You're not going to be performing as a registered rep. You can continue to receive commissions that you put on the book or continuing commissions from customers that are being serviced by somebody else. We're going to waive your CE requirements. That's the least we can do for you. We're going to halt the 2-year expiration clock. And then when you come down back within 90 days, you have to tell us what you're going to do. I've had some Marines back in the day, decades ago when I was a Marine, who got called to active duty, and then they decided that, they wanted to be a Marine full time again. So, if you have an epiphany, you just let us know, but you have 90 days to do so. I wouldn't get too hung up on rule numbers. They'll give you context, but FINRA Rule 3110 is about OSJs and supervising branches. The point being, they have to be inspected annually. And if it's a non-supervising branch, then the minimum is going to be every 3 years. FINRA Rule 3120, designated principals must submit to the member senior management a detailed report on supervisory controls. Summary of the test results, significant identified exceptions. Here, what I would be thinking about is our annual anti-money laundering test, or AML test. Each report to senior management in the calendar year following the calendar year which a member reported 200 million or more in gross revenue. I wouldn't worry about the 200 million. There used to be a lot more of what we call small broker dealer exceptions, not so much anymore. I would just know that if there is an exception to which you're not doing, you better have it in written form and be able to produce it to FINRA. So those reports would be in the following areas: trading and market activities, investment banking activities, anti-fraud and sales practices, finance and operations, supervision. I told you the one I'd be aware of is the AML test conducted annually, and it's got to be by a third party. And then there has to be in our WSPs. WSPs are written supervisory procedures And remember, we ask all reps to sign that they've read it, they've understood it, and they'll abide by it. And there has to be a section in the WSPs about AML, anti-money laundering. Business continuity plans would be disclosed at the account opening. And there also has to be a link on our website. The link doesn't have to actually give you the business continuity plan, but it's got to kind of tell you how to obtain a copy if you'd like. And then there also has to be a link to a broker check on that website as well. You have to identify to FINRA who your two contact people are going to be. So 2 associated persons to FINRA for emergency contact. And then you update that promptly, but you review it annually. Forms, we have Form U4, hello. Form U5, goodbye. Form U6 for problems, reporting regulatory problems. So U4 is amendments need to be made within 30 days. The representative, has to make those to you, and you to FINRA. When I say you, I mean collective, the principal or the firm. U5 is filed within 30 days. We have to give a copy to the former employee. A new employee will get a new employer gets a copy of the U5 and does what we call an amended U4. U6 are for disciplinary actions taken by regulators, and that U6 is how we report that regulatory action. We talked a little bit about OSJs. We talked a little about branch supervision, but we said that the customer records, including complaints, are kept at the OSJ level. We talked about an annual compliance meeting. Maybe we haven't, but you need to have an annual compliance meeting for the reps. It can be done individually. It can be done in group. It has to be interactive, so you can lock down the call or webcast, but at the end, you got to give reps a chance to say what's on their mind from a compliance standpoint. If FINRA tells you to start recording calls, you have to do so within 60 days of notification from FINRA. The definition of a branch office excludes the following. So the primary residence of the rep, as long as he's not meeting customers there, any location other than a primary business not used for more than 30 days, a location of convenience, like a satellite office where I say, hey, I'm up there on Tuesday, Thursdays, afternoons, kind of like an executive suite. Any location not used for a non-securities business, what that means is insurance. So on your test this afternoon or tomorrow, non-securities means insurance. And, if I am an insurance agent and I have a bunch of people who work for me that have Series 6s, and, at what point does my insurance office become a branch of the broker-dealer? And the definition there is if we do more than 25 securities transactions. When I think of this rule, I think of insurance agent who's the managing agent, and he's got these people with 6s and they're doing mutual funds and variable annuities. That may not be the case, but that's what I kind of think of in my own mind when I think about that. The code of conduct. So the code of conduct is the ethical behavior that broker dealers and associated persons owe customers. And one of the major violations is to get customers involved in transactions not sponsored by the employing broker dealer. Broker dealers have an approved product list. If it's not on the approved product list, you're supposed to make written notice to the firm, and that amounts to approval, right? Because they'll either say yes or they'll say no if there's an adverse interest. The point about this rule is if you violate the rule, they'll say, an associated person sells an investment not sponsored by the employing broker dealer without permission. This is known as, and you would say, selling away. Now, this doesn't apply to passive investments where a rep's involved as like a partner or mutual fund. It's, outside, not business activities. Be careful. Outside investment opportunities that our rep may be involved in. A different thing about business activities, that too is something that we care about. I don't know of any firm that's going to let you do this, but to share at a customer account, you need principal approval and proportionate capital. Remember, house requirements can always be more stringent. They just can't be more lenient. Can the registered rep borrow from a customer under code of conduct rules? The answer is yes, if the customer is an immediate family member. The answer is a yes if it's a lending institution. And then once again, we got to have procedures in our WSPs about, making sure reps, when they read that and sign it, they acknowledge whatever those house requirements are going to be. If we are operating a branch of a broker dealer on the premises of a bank, We must disclose orally and in writing that securities purchased are not FDIC insured or are subject to investment risk. If we're going to have continuing commissions, there has to be a written agreement between, Rep A and Rep B about the continuing commissions, and the continuing commissions can only be paid by Rep B to Rep A on the book of business that Rep A put on the books. Here I think of a retiring broker dealer who's going to turn over his book of business to, somebody else in the office, expects continuing commissions. So, he has a referral and he says, hey, did you land that customer? I go, yeah, thank you very much. He goes, I'll expect that in my check. I said, oh, no, sorry, you don't get paid on, business that you didn't put on the books before you retired. Retail communications, very important. So it's either going to go into one of three buckets. It's going to go into a bucket called institutional communication. Our second bucket would be retail communication. And then our third bucket is going to be correspondence. Now, we don't really care too much about institutional communication on 24 because we're trying to protect, Joe Sixpack retail investors. So, there we just make sure that the institutional communication isn't, finding its way to retail because it would be different, right? But there's two versions, two potential things to be aware of. This afternoon, tomorrow, you remember if it's correspondence, if it goes to 25 or fewer retail investors in a 30-day calendar period, I'll repeat that, it's important. Correspondence sent to 25 or fewer retail customers in a 30-day calendar period. The point there is you as a principal can approve that pre or post distribution. Whereas if it's retail communication, meaning it's going to more than 25 retail investors in a 30-day calendar period, well, then that means you would have to, approve that as a general securities principle pre-distribution. We're also going to file retail communication with FINRA. We file either 10 days prior to first use or 10 days after first use, depending on 10 days prior, if we're a new firm or it's a particular type of retail communication regarding derivative securities. For example, options would always be pre-filed. Anything derivatives, PACs and tax EMOs would be pre-filed. If you're a first-year firm, you pre-file. Now, if you get in trouble, they can put you back on the pre-file versus the post-file. If you allow instant messaging, you have to be able to capture that. That's current. Things live forever on the internet, but boy, that's very current right now. Research reports, if we choose, research reports, remember, are considered retail communication because, we're going to send it to people, hope they'll be impressed, open an account, and do some business with us. That being the case, research reports can include our past performance. But if we do decide, now remember, kind of tricky, we don't have to refer to our past performance, but if we do, then we have to go back 12 months and show comparable recommendations. So we can't cherry pick is the point. Now, remember, if I don't refer to past performance, then I don't have to do that. We always have to include the date of the report, a disclosure of a control relationship, right? So if this is Merrill Lynch writing a report about Bank of America, we'd have to disclose there's a control relationship between the issuer, Bank of America, and Merrill Lynch. Remember those control relationships, a couple other test questions about control relationships. I can't use my discretionary authority when there's a control relationship. So if I'm a Merrill broker and I say, hey, have you been following the bromance between Berkshire Hathaway and Bank of America? I think you should pick up 1,000 shares. And you say, well, Dean, I know why you're bothering me. I have discretionary authority on my account. If you think I should buy it, just go ahead and do so. And I said, well, I can't use discretionary authority when there's a control relationship. I also can't use discretionary authority when it's a partnership. A partnership, the commission could be, 8%, about 100 grand, it's like $8,000. ETFs is like $9.95. So research analyst conflicts of interest. So the analyst's compensation cannot be tied to investment banking transactions or and tied to general investment banking revenue. But if it's, what we mean here is it can be tied in a general way, but if it is, it needs to be disclosed. But it can't be tied to specific investment banking transactions. The analyst must disclose if they or their household members are going to have a financial interest in the subject security. Analysts cannot trade against their own recommendation. I'm trying to bring this in an hour, but behind every rule there's a story, and this is really, really embarrassing about why we had to have some of these rules based on research analysts who were privately sending emails to their friends saying, "Can you believe this?" So I won't get into it because we're trying to bring this in at 60 minutes. Anyways, analysts must disclose any investment banking fees they received from the issuer over the prior 12 months, any fees expected over the next 3 months. We have to make an annual report to FINRA attesting to compliance with these rules. We talked about the code of conduct. The other thing we should be aware of is the code of procedure. So code of conduct is ethical behavior that associated persons and broker dealers owe customers. And code of procedure, I think a good way to remember this is the COP. If you do bad things, the COP shows up. So complaints issued by the Department of Enforcement. So not bueno if you hear from the Department of Enforcement. You as a respondent, your firm or yourself have 25 days to make a response. A pre-hearing conference is held within 21 days of the respondent's answer. If you accept the fact set, waive your right of appeal, and consent to the disciplinary action, if you don't dispute those allegations, who knows? They might offer it to you. It has to be offered. You can't say, hey, how about that minor rule violation thing? No. But if it's a minor rule violation, no more than a fine of $2,500. Sanctions are effective no sooner than 30 days after the written decision. If you want to make appeal, so, if you think the Department of Enforcement was unfair, you could appeal to the National Judiciary Council, then the SEC, ultimately to court. I would tell you, you're making people madder as you go up the food chain, but you can appeal. If you're going to do that, you have to do so within 25 days. Now, remember, you can't do that if you accept, waive, and consent. That's if you want to dispute it, then that's how you do it. Release of disciplinary action through broker check. There's not going to be a release for monetary sanctions of less than $15,000. So the last code of conduct, code of procedure, the last code is the code of arbitration. And the code of arbitration is used to settle civil disputes. A response is required within 45 days. The awards need to be paid within 30 days. The statute of limitation is 6 years. If it's a dispute between member firms over 100,000, there'll be 3 non-public arbitrators. Public arbitrators are never involved in the securities industry. If it's a customer dispute over 100,000, 2 public arbitrators and 1 non-public arbitrator. You can request, I wouldn't get too hung up on that. The point is, if it's a retail customer, it's not a lot. They can request an entire panel that is public. Customer accounts. So opening customer accounts, we need as a minimum your name, your physical address, your date of birth, and your tax ID or social security number. Within 30 days, we're going to say, hey, listen, this is really important. I want to make sure I've got every T crossed, every I dotted. And so I'm going to send you a copy within 30 days. Please check it over. We also send it out to you every 36 months. We have a customer identification program. We need a picture ID. So a military ID would work. A driver's license would work. A passport would work. Please note a birth certificate would not work because it doesn't have a picture. We contact the Office of Foreign Asset Control to make sure we're not accidentally opening somebody account with somebody who's under sanctions. Regulation SP, we make initial and annual privacy notices to our customers and tell them if they don't want us to cross-solicit, for example, we make it easy for them to opt out. Margin accounts. A margin account is where a customer intends to pay part of the purchase price and wants the broker-dealer to lend the balance. So that's controlled by the Federal Reserve Board. That's Reg D. Right now, that's 50%. So if you bought 1,000 shares at 40, I say, hey, you want to do it in your cash account or your margin account? You say, let's do it margin. A broker-dealer loans you 20 grand, you put up 20. Now, the reason we love margin accounts is in my example of 1,000 shares at 40, I'm not lending you broker-dealer money. What I'm going to do, and you acknowledge this in your credit agreement, your hypothecation agreement, which are mandatory, your loan consent form is not it, but we tell you that the securities are in street name of the broker-dealer. If you don't fulfill your responsibilities, we're going to sell you out. But what we're going to do is rehypothecate 140% to Mr. Banker. So in my example, you bought 1,000 shares at 40. I don't think you have to do any calculation here, but 140% of that is 28,000 worth of collateral. 28 divided by 40, 700 shares. So I'm going to take 700 shares of the customer securities to Mr. Banker and get a loan for the customer. Perfectly copacetic to use customer securities to support customer indebtedness. Now, the 300 shares that's not at the bank are called excess margin securities. and I need to segregate those and lock those up. So what I can't do is use customer securities to support broker dealer indebtedness. Now the value of the collateral is going to go up and down, so I'll make the adjustments with that bank. All right, stupid but testable, drives me nuts. Remember, if you open a new margin account, it's less than $2,000, you pay in cash. Between $2,000 and $4,000, you're going to pay $2,000. So stupid, but testable. A pattern day trader is somebody who does 4 or more day trades in a 5 business day period, and their minimum is going to be $25,000. Portfolio margin customers can be approved to do uncovered option writing, naked calls, for example. Equities, ETFs, futures, warrants are subject to conventional margin only. The one I would worry about here is we can't lend you money by new issues. It's considered a new issue 30 days from the effective date. Order tickets are prepared prior to execution. Account transfer is pretty testable. You have 1 business day to validate, and you complete within 3 business days of the validation. Direct participation programs, the maximum compensation for a roll-up is 2%, and it cannot be contingent, meaning, contingency and doing it. Not all orders, but not held orders are considered day orders. Customer mail can be held for 3 months. Now, after 3 months, if you want us to continue hold, it can't be for convenience. Security would be acceptable, but not for convenience. All right, so let's talk about investment banking. I'm just looking at my timing here. We're 20 minutes. Let me know if you find these things worthwhile. They've got a good reception. Now, remember, this is not a teaching tool. If you're watching this and it's not the day before your exam or the morning of, then please, save it for later, because I get a little worried about doing these letters. But hey, they've been popular, so we'll continue on. 9 and 10 is next. All right, so investment banking, the underwriting process. The syndicate will be formed with an underwriter as lead, right, manager. So one of the common themes is the manager is always responsible in underwritings, and the selling party in the secondary market is always responsible. So, if you get some question about who's responsible, it's either going to be the sell side or the manager in most circumstances. Here, it would be the manager. So we're going to have an agreement amongst the underwriters that specifies our participation. If we're going to have an all or none or a mini max offering, we have to have an escrow account, and we can't break escrow until we meet whatever the escrow requirements are, those contingencies. If it was, for example, 10 million shares all or none, we don't break escrow until we get 10 million shares. FINRA 5130, firms, employees, finders, and fiduciaries and portfolio managers are restricted, as are immediate family members. If we didn't have the restrictions, you'd never see the good stuff, because we would keep it for ourselves. So we have to make a bona fide good faith distribution to the public. We're not supposed to be giving IPOs allocations to restricted persons. We have to make a bona fide distribution. We can't withhold. I just talked about that. We can't demand reciprocal business dealings. So, reciprocal business dealings, men say, if I'm going to do this for you, then you got to do this for me. You got to continue to use me as your underwriter. Otherwise, I'm not going to do this one for you. Regulation M. So Regulation M is about the conflict of conducting business in the primary market at the same time we're conducting business in the secondary market. So under Reg M, we have Rule 101 that defines the restricted period. Underwriters who are market makers must either get excused withdrawal or act as a passive market maker. Rule 102 says issuers and its affiliates cannot bid for or purchase the security during the restricted period. Rule 103 is about passive bids being no higher than the highest independent bid unless it reflects a customer limit order. So, unsolicited customer limit orders could be the exception to this if you're, when you're testing, right? Under what circumstances would this be acceptable? Net purchase is limited to 30% of the market maker's average daily trading volume. Rule 104, stabilization, very testable. So stabilization is permitted for fixed price offerings, also known as firm commitments. It has to be in the prospectus. Better to have in the prospectus and not need it than need it and not have it. And there could be on the stabilization, it has to be at or below the public offering price. There could be penalty free, and it's a one-sided quote, right? It's going to have a bid, stabilizing bid. Rule 105, short positions that we establish within 5 business days of the effective date cannot be covered by stock we're purchasing at the offering price, using our green shoe, for example. Regulation A, we can raise up to $75 million. And these are exemptions under 33. At tier 1's up to 20 million, but tier 1 goes up to 75. Tier 2 is for less than that. I would just know we can't raise more than $75 million using this exemption. Intrastate offerings, again, another safe harbor under 33. And the safe harbor here is, again, the 80% rule. We have to have 80% of the issuer's proceeds, 80% of the issuer's assets and business with the state. We can only sell to residents of the state, and then residents can resell it after 6 months. Rule 145, mergers and acquisitions. If we're paying for an acquisition, for example, Disney is buying Fox and issuing shares to do so, those shares don't need to be registered. Reg S. So it's a U.S. issuer selling non-registered securities offshore. So Reg S is a U.S. issuer selling or issuing securities offshore, therefore not subject to the SEC registration rules. So that means we better not have any selling efforts in the U.S. And distribution compliance period is up to 1 year, 40 days for debt. But typically what we're saying is the securities are being purchased unregistered. If they're going to come back onshore, back into the U.S., there's going to be a holding period, just like there would be for other unregistered securities. That could be up to 1 year. The most common example, common version would be 6 months, but 40 days for debt. Reg D, for 504, we're 10 million or less. 506, we can raise an unlimited number, an unlimited amount of money. We should definitely know that 506B does not allow for general solicitation, but I can have 35 non-accredited investors. 506C allows for solicitation, but I can't have any non-accredited investors. So 506B up to 35 non-accredited, 506C general solicitation unlimited. And I would definitely know accreditation standards. Remember, it's $1 million net worth exclusive of your primary residence, or $200,000 for the last 2 years with the expectation of $200,000 this year, or married and filing jointly $300,000 for the last 2 years with the expectation of that this year. Good way to remember it. 1, 2, 3. 1, 2, 3. Rule 144 is about selling securities. 144, remember, there's a minimum 6-month hold for securities you receive from the issuer directly that are unregistered. Now, if you are a control person, you're an officer, director, principal stockholder, or immediate family member, regardless of whether the stock is registered or unregistered, there's going to be a volume limitation. So the volume limitation applies to all stocks sold by control persons, and that stock is called control stock. And so that stock is maybe registered, some is not. Oh, it doesn't matter. If it's unregistered, there's a 6-month hold. If it's registered, they still are subject to the volume limitation. And a good way to remember it is 144. So you file the form no later than concurrently at or prior. The form is good for 90 days. And what you can sell is up to 1% of the outstanding stock or the average of the last 4 weeks trading volume, whichever is greater. So good way to remember it, 144. 1% or the average of the last 4 weeks trading volumes up to 4 times a year every 90 days. We have a de minimis for this. If the filing is waived, if the amount to be sold is 5,000 shares or less, or has a value of $50,000 or less in a 90-day period. SEC Rule 10b-13. Again, I wouldn't worry about the rule numbers. I'll give you context on the test. While it's test prep, don't let this, like as cloud your mind as you're on your way to your exam. If you're listening this to in your car, the audio file, don't let this cloud your mind. But what we mean by that is, the rule numbers give you context. Test prep vendors, typically don't, but the test today or tomorrow should give you some context. But anyways, tender offers have to be open for at least 20 business days. The target company has to tell you what they think you should do in regards to the tender. They have 10 business days to do that. Once there's a tender offer, if it's like Oracle tendering for PeopleSoft, Oracle cannot make any more open market purchases now that they've made a tender for the PeopleSoft stock. Veritas can't short into a tender because, again, once the acquisition is over, the stock won't be there, so you won't be able to get back the borrowed stock. So no short tendering. We said the shareholders of the target company are permitted to tender their shares only extent their net long. So, maybe I've shorted against the box. I have 1,000 shares. I short against the box 300. It means my net position is 700, and that's what I can tender. Amendments, once we amend, the amendment has to reopen for another 10 business days. So if Oracle says, okay, we're raising the offer from 18 to 22, then get you 10 more days. Company buyback, so 10B18, company buyback transactions on any given day can only be effected through one market maker. We don't want the issuer manipulating their own stock price. The transactions on any given day can't exceed 25% of the average daily trading volume. The transactions can't affect the opening or close. That's called marking the opening, marking the close, big no-no. Safe harbor is available if the issuer is not involved in the first trade of the day or any trade in the last half hour. The price can be no higher than the highest current independent bid or last sale. Members, firms selling their own securities, right? So, Goldman Sachs went public, who better take Goldman Sachs public than Goldman Sachs? So there are rules about member firms selling their own securities. Employees can buy. So there is no restrictions to, usually, remember we said restricted persons can't have IPO allocations. Usually Goldman Sachs employees would not get an IPO allocation for a company that Goldman Sachs is taking public. But if it's Goldman Sachs, the employees can buy. It's considered an issuer-directed sale. You have to have an independent underwriter engaged to price the IPO. And my Goldman example, when Goldman went public, it was Lazard. No surprise, when Lazard went public, it was Goldman. So it has to be an independent underwriter, right? Because, what does Goldman think this is worth, Written permission is required for discretionary accounts. Customer checks are placed in an escrow account pending a net capital computation. We have a committee on corporate finance, the corporate financing department. The information filed is about the underwriter's compensation. The manager, we said, is always responsible for this kind of stuff. And so the manager is going to file within 1 business day of filing the registration statement. This applies to equity and convertible debt securities. Non-convertible debt and non-convertible preferred stock are exempt if they are rated as investment grade. And what the committee is going to look at in terms of compensation is how much freely transferable stock, options, and warrants did the underwriter receive. Options or warrants, particularly red flag with exercises price below the public offering price, and all are considered unreasonable. So, this will be a Sesame Street trick if you get it. Like one of these things is not like the other. Insider trading, both the tipper and the tippee are liable for insider trading. Civil liability is triple, 3 times losses avoided, profits made. The criminal penalties are $5 million and 20 years in prison, and up to $25 million for the firm as a fine. If you're trading along as a contemporaneous trader, you could be held accountable as well. Fairness opinions. In writing a fairness opinion, the firm must disclose the following, among other things: whether you were a financial advisor to any party to the transaction, if you receive compensation contingent on completion of the transaction, any relationships that existed during the past 2 years with any party involved in the transaction, and whether any compensation was or will be received. Any information that formed a basis for the opinion was supplied by the party requesting the opinion. In other words, if I'm basing this on what the information the issuer provided, I need to disclose that. Hart-Scott-Rodino is about FTC wants to know about notification about mergers. So we're going to make a pre-merger notification to the FTC, Federal Trade Commission, for transactions that exceed 92 million or more. I should say exceed 92 million or more. I'm coming to you in 2022, so please note, the internet lives forever, and some rules like this tend to move. So just check whoever your test prep vendor is in their log. I told you, if it's tomorrow, you have time to do that. If you're on your way to the exam site, don't worry about it. The information filed to let the FTC determine whether there's an antitrust problem. They may or may not think there's an antitrust problem. The firms wait 30 days after filing for consummation of the deal. All right, trading and market making. Before orders are crossed, the New York Stock Exchange says before we cross orders, we have to offer it at the crowd, out on the floor, at 1 cent above the current bid. Rule 72 defines a block trade of at least 10,000 shares or $200,000 or more. Market on close orders can't be entered after 3:50 p.m. If we want to remove ourselves, the issuer wants to remove its securities from the New York Stock Exchange, they file Form 25, and that's submitted to the SEC, and it's effective 10 days after the filing. OTC equity securities, in the OTC equity securities, the major market centers are New York and NASDAQ is an over-the-counter marketplace, a negotiated quote-driven market. And so those are I think of it as NASDAQ, the big boys, right? NASDAQ stands for the National Association of Securities Dealers Automated Quotation System. So to be listed on NASDAQ, the minimum bid price is $4, and you have to have 400 round lot shareholders. So once we do the IPO, then it's going to be trading in the NASDAQ marketplace, and we're going to have what are called market makers. And if you register as a market maker, right, your application is effective upon approval from FINRA. You say, I want to show up. What I have is a level 3 NASDAQ data feed, and I want to enter quotes. So I can enter quotes once within the 5 business days, right? Excuse withdrawal for cause requires NASDAQ approval. So I say I want to withdraw. And again, excuse withdrawal would be for 5 business days. And then I can do voluntary termination as a market maker, or that's on NASDAQ, or if it's like the third market or some kind of alternative display facility for 20 business days before I come back on. They don't want you going on the system and off the system is the point. So once I'm approved to enter my quotes on the level 3 NASDAQ data feed, I do so within 5 days. If I'm an existing market maker and I want to take an excused withdrawal for up to 5 business days, that would be the same. And then I can just say, I no longer want to provide liquidity in the security anymore. That'd be 20 days, 20 business days. In terms of best execution, we some firms and some institutional customers use what's called volume weighted average price. And that considers the number of shares and the price level to determine average. And then once we get the average, anything under that would be good execution. Anything above that would be not as good. There would be other factors involved. Short interest is very testable. Short interest reporting, very testable. We report twice monthly for short positions for both the customer and the broker-dealer, our proprietary accounts. It's reported on the 15th and last business day of the month, and report on trades that have settled as of reporting dates. The consolidated audit trail, time sequence trail of orders from entry to execution. It applies to equity securities and options. The daily reports are on an order-by-order basis. Trading halts. T1 is for news pending on NASDAQ. So T1 news pending. So we say, okay, let's stop quoting until we hear what the news is. T2 means the news has been released. And T3 is a 5-minute window for people to enter their quotes. And then remember, as we start entering the quotes again, we got to make sure we don't walk across the market. We have a 5% policy, not a rule, policy for guidance of wise men and women, and it doesn't apply to the primary market. It's based on the inside market, the highest bid and the lowest ask. So a markup is going to be based on the lowest asking price, and a markdown would be based on the highest bid price. The inside market is the highest bid and the lowest ask. Regulation NMS. Rule 611 prohibits trade-throughs that occur when a firm executes a custom order at a price when a better price is available in another market. So in other words, if there's a better price available for the customer, I got to attempt to get that for him. 612 deals with minimum increments regarding pricing. For stocks priced at $1 per share, the minimum increment is 1 cent. Sub-penny pricing is permitted for stocks under $1. 605 requires market makers that trade listed in NASDAQ securities to prepare monthly reports on execution quality. Rule 606 requires firms to disclose in quarterly reports their order routing methods. What we got in mind here is payment for order flow, right? So Robinhood is being paid by Citadel to receive the order flow from Robinhood customers. That needs to be disclosed in terms of order handling practices. Market makers, which they route significant portion of their business. And remember the preference market maker, in my example, Robinhood Citadel. Citadel has to honor the inside quote, the highest bid and lowest ask. They could do better than that, but that would be their minimum obligation. Limit order protection rules. This is also called the Manning rule because Mr. Manning got so upset, he fired a class action lawsuit. So what was Mr. Manning upset about? So if a market maker receives a customer limit order, and the limit order is a better price, then, I'm going to have to display that. Or if I get a better price, I have to pass it along to the customer. So, hopefully you're prepared for limit order protection. This comes up all the time, when people asking for my help. So if my bid is 18 and the customer wants to, I think of it as with a customer market order, you're on the opposite side of the market maker. With limit order, you're on the same side as me as a market maker. So if I have a bid at 18 and a customer gives me a buy limit at 18 or 1801, then, I'm going to have a limit order display kind of a situation. I wouldn't worry about it because if it's tomorrow, maybe you can review this if you need to, but if you're on your way to the exam, it's this afternoon, I just got to go with what you got on these 60-minute things, right? We're just trying to give you an overview of what to expect when you get down there, get you in the flow. Remember, we're not trying to teach you limit order protection. Maybe I'll link that or market making to the pinned comment or the video description if, you want to review stuff. Anyways, the other thing I would just make a note of it when you're doing your test this afternoon or tomorrow, whatever I do for myself, I got to do the same for my customer. So, if I get past a price improvement, I got to pass that on to the customer. I have 30 seconds to, I just told you I might have to update my display and I have 30 seconds to do so. OTC market regulations. You shouldn't trade ahead of customer orders. That's called front running. That's a big, big no-no. Regulation show is about short sales. And, we're supposed to be able to make delivery on T+2 of the borrowed stock. So regulation show mandates a locate requirement part of the short sale of any security. And it requires a closeout of fails to deliver in the threshold security. So I don't have the securities after 13 consecutive settlement days. So that's called regulation show. CAT reporting obligations. All members that receive orders in national market system stocks are required to report to the CAT. Remember, CAT, as we said earlier, is the consolidated audit trail. All proprietary trading activity, including market making, are subject to CAT reporting. There is no exclusions or exemptions. If an introducing firm elects to have their clearing firm report on their behalf, the firm has to have a signed agreement in place, and it must not assume that clearing firms will report. They get mad when you say, well, I thought they were doing it. No. So you have to have that in written form. If you want to make a market in a non-NASDAQ OTC stock, so in the over-the-counter markets, we said NASDAQ is for stocks. The preeminent over-the-counter market for stocks is NASDAQ, but there's others. And if you want to make a market in a non-NASDAQ OTC stock, you can do so by filing Form 211. You file Form 211 at least 3 business days before entering your quotes. Now, you can also do what's called piggybacking. That's based on there already being a continuous quote on the screen. So I look at the screen, there's a continuous quote. I say, oh, I'm going to piggyback. On non-NASDAQ OTC stocks, you don't have to maintain a 2-sided quote. In NASDAQ stocks, very testable, I'm always going to have a 2-sided quote, a bid and an ask. The exception would be if it's a stabilizing bid. Well, then it would be 1-sided. But other than that, I have to have a 2-sided quote, and I have to have a display of my size. And my minimum display or my minimum obligation would be to effect a transaction of at least 100 shares. But if I'm displaying size, I'd have to honor size. If I don't, very testable, it's called backing away. Now, in non-NASDAQ OTC stocks, that's not true. We can have 1-sided quotes. They can have indications of interest. We can have workout. We can have all kinds of different crazy kind of quotes that we would not be allowed to have in NASDAQ. TRACE, the Trade Reporting and Compliance Engine, is for the secondary trading, reporting of the secondary trading of debt securities. The trade reports is made within 15 minutes of execution. And then that report is going to be available to the public. So trade reports are within 15 minutes. I would know it's dual siding reporting, so both the buyer and the seller are going to report. Consolidated quotation system. The Consolidated Tape Association manages the dissemination of the real release of pricing information. I wouldn't worry too much about it, but they're what we call a security information processor. Penny stock rules. Penny stock rules. So first ask questions, what's a penny stock? It's a non-NASDAQ OTC stock under 5. And if it's a non-NASDAQ OTC stock under 5 and you're a new customer, you have to sign a suitability statement. You don't have to sign this if you're an established customer. An established customer is somebody who's had funds with us for a year or done 3 trades. You have to receive a disclosure document, disclosure statement. And again, we have to make sure that you get a monthly account statement. Usually the minimum statement to send you is quarterly, but if it's a penny stock, then it's going to be monthly. Reverse convertibles. Reverse convertibles are debt instruments that have an embedded put option. I think we call them reverse convertibles to make it clear to and make it unclear. Why FINRA hates these, I hate them too. I think they're mislabeled. The customer should understand he's the put E, right? So that's what a reverse convertible. It's a put provision where the issuer can put the convertible to you and make you accept the equity security. So debt instrument embedded with put options, allowing the issuer the right to convert the bonds into the shares. So if the option of the shares underlying they fall below a set price, the bondholders will receive the shares rather than the principal. And again, FINRA, wants to make sure customers understand that. So they typically have, because of this being a disadvantage to the bondholder, they typically have a higher interest rate. And so, that's why people get entangled in these things. I know that QUIB, a qualified institutional buyer of securities, is an institutional investor with 100 million or more in assets under management. And what a QUIB can do under 144A is buy unregistered foreign and domestic securities. So that's what QUIBs are allowed to do. NASDAQ book, we have an order display and execution system for NASDAQ listed securities. And you can show up in the NASDAQ order display NASDAQ book as either attributable, where you have your market participant ID, GSCO, for example, is Goldman Sachs, or you can show up in the NASDAQ book anonymously and just show up as, for example, instead of GSCO, NSDQ, right? Just sometimes you might want to remain anonymous. Locking and crossing, very important. Remember, locked is when the highest bid is the same as the lowest ask. A cross is when the highest bid is over the asking. You're supposed to make sure you don't enter a quote that does that. What you do if you're, for example, moving your bid is you say trade or move, but you should recognize this afternoon or tomorrow a locked or cross market. The person entering the quote is the person responsible for making sure they haven't locked or crossed the market. Now, as it relates to the NASDAQ book, those will not be displayed, no problem. They'll be automatically executed. So we wouldn't have to worry about locking or crossing in the NASDAQ book. The system shows the interest at the 5 best price levels. For example, Facebook has 55 different market makers. Do I really need to look at all 55 of them? I doubt it, right? So NASDAQ book is easier. It shows me the 5 best price levels. The maximum order quote size on the NASDAQ book is less than $1 million, 999,999. And the price time is the assumed priority, meaning whoever has the best price goes first. But, if I show up there and my price is the same as yours, and we both have the highest bid or the lowest ask, then whoever got there first goes. That's called price time, and that's the assumed priority. So if you want to go to the front line, you come with a better price. And if 2 market makers are displaying the same price, then it's the market maker that was there first. Trade reporting facilities. So we have the alternative trade reporting facility. We have the alternative display facility, and we have the over-the-counter reporting facility. They're all used to report OTC trades. They're open from 8 a.m. to 8 p.m. Reports, very testable, have to be made within 10 seconds. In an interdealer trade, the only time the buy side reports, as I said, two big kind of common themes. When it comes to banking, it's the manager responsible. When it comes to trading, it's usually the sell side that's responsible. So the one circumstance in which the buy side will be responsible for reporting is if the buy side is a market maker and the selling firm is not. So, just, in your own mind, kind of say, okay, sell side's reporting unless the buy side is and the sell side isn't. T trades are affected outside normal business hours, and we would disclose that, to you. So as of trades are affected outside normal business hours reported next business days. So T is a modifier that is telling the marketplace this is a trade that was affected outside of market hours, but there was time to report it today. As of means we're going to report it to tomorrow. If we're doing an initial public offering of a NASDAQ security, the public offering price is going to be the first bid in the NASDAQ book. For example, Facebook went public at 38. So the first bid is going to be at 38. There's going to be a 15-minute quotation only period. Now, people forget, but that was not a, I just did a little short on IPO. Does IPO stand for instant profit opportunity, or does IPO stand for it's probably overpriced? Is it going to be sticky or hot? We don't use those terms test-wise anymore, but if it's sticky, nobody's going to buy my Facebook stock. Morgan Stanley's the lead underwriter at 38 if they can get in the secondary market for less than that. So we're first going to start the first bid at 38. In this case, Morgan Stanley is going to stabilize the Facebook stock. And remember, we said if they're stabilizing the Facebook, it's got to be at or below 38. Only one syndicate member can do it. We sometimes refer that as the stabilization agent. And, depending on who it is, in this example, a lot of UBS customers were the ones selling. I remember there's a penalty bid for that if your customers are coming unstuck. Let's see. So federal securities registration regulation. We have 33, known as the Prospectus Act. Sometimes you can get questions right by covering up the screen. Are they asking about paper prospectuses? 33 said if you're going to sell brand new securities to the public, you have to make a registration statement with the SEC. Now, as we mentioned, there are safe harbors available where, we can sell securities without making a registration statement. Those are called unregistered securities. And we talked about Reg D, we talked about Rule 147, we talked about Reg A. There are also exempt issuers. Exempt issuers are the U.S. government, municipalities. They don't have to make registration statements. Now, assuming we are going to be making a registration statement under 33, by the way, if you cover the screen, people and places would be 34. So Congress knew when they passed 33, they were going to come back and pass 34. 34 is about people and places. And President Roosevelt at the time called all this legislation the New Deal. He said, listen, you're going to thank me later, securities industry, but I'm changing your industry from let the buyer beware to let the seller beware. You've got to make sure you're doing this correctly. So we're going to enter into what's called the cooling off period or quiet time, which is a minimum of 20 days. During the cooling off period or quiet time, what I can do is send you a preliminary prospectus, also known as red herring. It has a range of prices. Based on that preliminary prospectus, no final offering price, I can accept indications of interest, which are non-binding on all parties. And I can place a tombstone, which is considered to be not an advertisement. A tombstone says this is neither offer to sell nor solicitation to buy. Now, the biggest thing I need to make sure I don't do is make no omissions of material facts, that my registration statement is not false and misleading. And assuming we get through that, then there's the effective date, right? The effective date is where now it's a public company, reporting company with the SEC. And then remember, we can't extend credit for new issues. It's considered new issue 30 days from the effective date. Mutual funds, remember, open-end mutual funds are continually offering new shares to the public. And so they're going to have a prospectus requirement. And the mutual fund has been registered for more than 5 years. Must a prospectus be delivered during the sale? The answer is yes. So there's sometimes a trick about, do you have to deliver a prospectus to a mutual fund purchaser? And the answer is yes. We said 34 is about people and places. Margin requirements, remember, as part of 34 was Reg T. The roaring 20s, broker-dealers were in charge of credit extension to their customers, and We loan you money to buy anything. And, at the end of the roaring 20s, there's a crash. We decided that maybe broker dealers aren't the best decision maker about credit extension to customers. 34 created the SEC. The first commissioner was Joe Kennedy. President Roosevelt's new dealer friend said, how could you put Joe Kennedy in charge of the securities? You're putting a fox in charge of the hen house. He's one of the biggest securities crooks around. He said, who better as a gameskeeper than their former poacher? So anyways, annuities. So a fixed annuity is not a securities product. But remember, variable annuities are. Again, don't tell compliance because they'll be really upset with me, but I think of a variable annuity as a mutual fund with an insurance wrapper. A mutual fund with an insurance wrapper. And variable annuities, our reps are going to be selling them as non-qualified retirement plans. Non-qualified meaning you're using after-tax money to fund this thing. And then, once you reach retirement, 59 and a half, you can get start withdrawing, or you can annuitize and turn it into an income stream. These require heightened suitability. For example, this would not be a good recommendation for anybody who hasn't maxed out all the other types of retirement plans they have available, like their IRA through the retirement plans through their employer. And the thing that's really heightened supervision always is seniors. So, if it's a senior, why would they be investing in a variable annuity would be kind of be the red flag, right? The variable annuities have higher expenses. And the reason they have higher expenses, again, is because it's not only the investment product, but the insurance product as well. Equity indexed annuities are not considered securities because you can't have a negative reset. When they reset your equity indexed annuity, it's going to never go backwards from where it's at when we do the reset annually. Now, there's a participation cap in that. So, for example, if it's a equity indexed annuity and it's capped at 85% participation, that means the market goes up 20%, you're only going to get 85% of the 20. Okay, well, I think I pretty much did it. I think I came in. Those were the notes I made, and saying, okay, well, if I'm going to try and talk about the 24 and 60 minutes, what is Dean going to talk about? So let me know. This will be going up shortly into the playlist. We've got good feedback, so good or bad, tell me what you thought. I always can hit the delete key. If you were 24 and you happen to have a 9 and 10, that would be even more helpful to me, because if the feedback is it wasn't helpful, then I won't waste your time and mine doing a 9-10 version of this. So far, we've done all the versions have been positively received. Remember, inch by inch, the 24 is a sense, yard by yard. The series 24 is hard. So I'm sending you good testing vibes, either this afternoon or tomorrow. Circle back, let me know what happened to you. I don't know if you are aware of this, but if you're not, we have a Reddit community. Again, if you're testing tomorrow too late or tomorrow, but you can come back, and it's good for morale to post your testing victory at our series 24. That's our Reddit community for 9s, 10s, and 24s. Okay, I'll see you for next time I see you.